£1 should not be able to wreck your budget, but for many older people, £1 can start a chain reaction. At £16,001 in the bank, the system can look at you very differently, and if you read the rules the wrong way, you can lose far more than you think. If you want updates that help you protect your money before a letter lands on the mat, subscribe now, because these small rule changes can hit hardest when nobody explains them in plain English. A lot of people hear one simple number and stop there. They hear £16,000 and think that is it, game over, no help, no point asking. That is where the trap begins. Not because every rule works the same way, but because many people give up before they check what actually applies to them. Now, here is the part most people miss. Pension credit does not work like a simple on or off switch at exactly £16,000. Many people are shocked to find that there is not always a hard savings cutoff in the way they expected. What often matters is how your savings are treated, how other linked support works, and whether the amount in your account changes what the system assumes you can live on. For pension credit, savings above £10,000 can reduce what you get because the rules may treat part of that money as if it gives you extra weekly income. That does not mean you really receive that money each week. It means the system may act as though you do. So if you have £16,001, the problem is not just the number itself. The problem is the way that number can shrink your award, affect other help, and make you think you are not entitled when you still could be. Let me show you why this matters so much. If you are more than £10,000 over the savings line used in the calculation, every £500 or even part of £500 can count as £1 a week of extra income. That means £16,001 is treated much more harshly than many people expect, because that one extra pound sits above 16,000, the amount over 10,000 becomes £6,001, and that can be treated as £13 a week of assumed income, not 12. That one detail changes everything. £13 a week may not sound huge when you hear it once, but over a year, that is hundreds of pounds, and the bigger danger is what it can do around the edges. A smaller pension credit award can change access to other support, change what you think you qualify for, and push people into silence when they should be making a claim or asking for a review. Have you ever seen a rule where having a little bit more money somehow leaves you worse off? If that sounds familiar, leave a comment with the word trap, because this is exactly the kind of thing families only find out after someone loses help. This is where the real problem starts. Many older people do not just lose money because of the calculation. They lose money because they believe the wrong story about the calculation. They say, I have more than 16,000, so I will not bother. Or they get a lump sum in the bank and think they must stop claiming straight away. Or they are scared of getting into trouble, so they stay quiet and hope nobody asks. That is how thousands can disappear without any dramatic event at all. No big court case, no loud warning, just one review letter, one missed claim, one misunderstanding, and one winter where bills go up while support goes down. The system does not always punish people with a bang. Sometimes it does it with paperwork. And there is another layer to this. Pension credit is one thing, but linked help can be another. Some support depends on local council rules. Some help works differently if you receive the guarantee part of pension credit. Some schemes look at savings in their own way, so the same bank balance can lead one person to say, I am still entitled to something, while another person loses help from a different direction. That is why the title of this video matters. The trap is not just the money sitting in the bank. The trap is the chain reaction. A person thinks they are safe because they saved carefully all their life. Then a funeral payment, a back payment, an inheritance, a house sale, or even a family transfer lands in the account. Suddenly they are above a line they barely understand, and the effect can spread into council tax help, rent support in some cases, and other forms of means-tested assistance. Now pay close attention to this next part, because this is where many people get caught out. The money that counts is not always just the cash in one's savings account. It can include money in current accounts, savings accounts, some ISAs, premium bonds, and other capital you can access. If you are part of a couple, it is normally looked at together, not as two separate worlds. So one partner saying, "This account is mine," does not always solve the problem. At the same time, not everything is treated the same way. The home you live in is usually not counted as savings for this kind of test. Ordinary personal belongings are not treated like money in the bank. In some situations, certain back payments or special types of compensation may be ignored for a period of time. That is why guessing is dangerous. The rules are full of details, and details are where people either protect themselves or lose out. If this applies to you or someone in your family, do not rely on one sentence from a neighbor, a Facebook comment, or something half remembered from years ago. Subscribe and stay with this channel, because the rule that matters is often the rule nobody mentions in the first conversation. Let us make this real with an example. Imagine a widow with modest savings of £9,800. She is careful, she watches every bill, and she may qualify for pension credit. Then she receives a small inheritance from a relative, and her balance jumps to £16,001. She hears from somebody at the bus stop that 16,000 means no chance, so she never makes the claim. That decision can cost far more than the £1 above the line. First, she may still have had some entitlement depending on her income and circumstances. Second, if she never claims, she may miss extra support linked to pension credit that could be worth much more than the weekly amount she expected. Third, if she delays, she may miss the chance to ask for backdating for a limited period if she was already entitled. In other words, the mistake is not only in the bank account, the mistake is in walking away too early. Now consider a different case. A pensioner gets a letter asking for a review and sends in bank statements. The statements show a balance over 16,000 after a back payment or a temporary build-up of money. The person panics and thinks they have done something wrong. They stop spending on basics, avoid phone calls, and assume a huge overpayment is coming. But sometimes the right move is not panic. Sometimes the right move is to explain where the money came from, when it arrived, and whether any special treatment may apply. This is the detail that changes everything. The system does not only look at what you have, it can also look at why you have it, how long you have had it, and whether it should be treated in a special way. If you sold something, received arrears, got compensation, or were holding money for a short period because of a change in your life, that context matters. You do not want the office looking at a number with no story attached to it. And here comes another danger. Some people try to solve the problem by moving money out of sight. They give a chunk to a son or daughter. They transfer money to another account and call it a gift. They spend fast just to get under a line. That can backfire badly, because if the authorities think you got rid of money on purpose to increase benefits, they may still treat you as if you still have it. That is often called depriving yourself of capital, which is a formal way of saying the system may decide you made yourself look poorer than you really are. So the fix is not to play hide and seek with your savings. The fix is to understand the rule before you move anything. If money was spent on a real need, that is one thing. If it was handed away mainly to protect a claim, that is another. This is why careful people still get caught. They are not trying to cheat, they are trying to cope. But rushed decisions made in fear can create bigger problems than the original savings figure. Have you had a review letter recently, or know someone who got nervous after being asked for bank statements? Tell me yes or no in the comments, because these quiet letters often cause more stress than any headline. There is also a timing trap. Many people wait too long to ask for a benefit check because they want to see if things get worse first. They wait for winter, they wait for the rent to rise, they wait until the savings drop. But if you are close to qualifying, delay can cost money. Pension credit claims can sometimes be backdated for a limited period if you met the conditions earlier, but that does not help if you never ask or if you ask far too late. That matters even more for people with low income and modest savings. Maybe you have slightly more than 16,000 today, but your costs are rising every month. Maybe you are using savings to cover food, heating, or care costs. Maybe your bank balance looks healthy on paper, but it is only there because you are stretching it across the year. The system may still say you have assumed income from those savings, even if the actual interest you earn is tiny. That is why the rule feels so unfair to many people. The money is counted as helping you more than it really does. This is also a warning for carers and adult children who help with paperwork. If you support an older parent, do not just ask how much is in the savings account. Ask where all the money is held, whether there are joint accounts, whether there has been a recent lump sum, and whether any letters from the pension service or the council are sitting unopened in a drawer. One missing piece can completely change the picture. Now here is the part families often overlook. Some people keep a child's money, funeral money, or house move money mixed into the same account as everyday savings. On paper, it can all look like one pot. But when a review happens, that can create confusion. If the ownership of money is not clear, the wrong amount may be counted. Good records matter. Clear statements matter. Simple notes matter. If this video is helping you make sense of a rule that never gets explained properly, share it with one person who handles money for an older parent or partner. Very often, the second pair of eyes is the reason a costly mistake gets stopped in time. Let us talk about what people should actually do when they are near or over this figure. First, do not assume you are out without checking. A proper benefit calculation is always better than a guess. Second, keep recent bank statements, letters about lump sums, and any papers that explain where money came from. Third, if your savings have changed, report the change if you are already on a means-tested benefit, and the rules say you must tell them. Silence rarely improves the outcome. Fourth, if you think a decision is wrong, challenge it. Ask for the reasons. Ask how the savings were counted. Ask whether any disregards, meaning amounts that should be ignored for a time, were considered. Ask for the calculation in plain terms. You do not need to sound like a lawyer. You just need to be calm, clear, and persistent. Fifth, check the linked benefits and not just pension credit on its own. Council tax reduction is handled through local systems and can vary. Housing support can depend on age and circumstances. Help with health costs, heating support, and other forms of assistance can interact with your main claim in ways people do not expect. This is why a single yes or no answer is often not enough. The real question is not, do I pass one savings test? The real question is, what help may still be open to me and what changes if I claim or lose pension credit? And please be careful with the phrase, I am only £1 over. In benefit rules, £1 can push you into the next counting band, the next review question, or the next wrong assumption. That does not mean you should be frightened of every small change. It means you should respect how the system rounds and groups money. With the rule about every £500 or part of £500 above 10,000 counting as extra weekly income, that £1 can trigger a whole extra pound a week in the assessment. This is where people start to see why the title says thousands, not pennies. The weekly reduction might be manageable on its own, but then you add the chance of missing pension credit completely because you never claimed. Then you add the possible loss of extra help that depends on the claim. Then you add months of delay, a review that goes wrong, or a council scheme that treats capital differently. By the time the year ends, the cost is no longer small. There is one more group I want to mention because they are often missed in these conversations. People who have done the right thing all their lives and built up modest savings often feel punished by means tests. They are not rich, they are not living comfortably, they are simply trying not to fall apart when a boiler breaks or a care bill appears. For them, £16,000 is not luxury money, it is safety money. So when the system treats part of it like weekly income, it can feel deeply out of touch with real life. But feeling frustrated does not mean you should stop checking your rights. In fact, it means the opposite. When rules are awkward, you need more clarity, not less. If you write yourself off too soon, the system wins twice. It reduces what you get, and then it convinces you not to ask questions. That is the real trap. Now pay close attention to this final practical section. If your savings are close to this level, review your position before the next benefit review arrives. Check whether any recent deposits were one-off payments. Check whether any money belongs to somebody else and should be clearly separated. Check whether you are in a couple and whether both sets of savings have been counted properly. Check whether you have had a change in pension income, rent, disability benefits, or caring duties that could affect the whole calculation. And if you are already over 16,000, do not disappear. That is not a strategy. Make the call, ask for the check, and get the answer based on your real facts, not a rumor. If you already receive pension credit or another means-tested benefit, read every letter fully and respond on time. Missing a deadline can turn a simple explanation into a suspended payment or a long argument. One more thing people forget is that small changes over time matter. Your savings today may not be your savings 3 months from now. Care costs, energy bills, home repairs, and daily living can reduce a balance faster than expected. So even if you are not entitled right now, that does not mean the answer will stay no. Put a reminder in your diary, recheck later. The biggest mistake is treating one result as permanent. If you want, write check again in the comments, because sometimes the best money advice is not complicated at all. It is simply this: do not assume, do not panic, and do not leave a possible claim sitting on the table. So here is the truth in one clear line. The pension credit trap is not just having £16,001 in the bank. It is what that figure can do to your calculation, your confidence, your linked support, and your next decision. One misunderstood number can shrink an award, block a claim, or make somebody walk away from help that could have protected them. If this topic matters to you, keep close to this channel. Subscribe for clear updates that cut through the noise, and share this with anyone over state pension age, anyone helping a parent with benefits, or anyone whose savings have just changed. The rules may be complicated, but getting the warning in time can save real money, real stress, and real hardship.